Well, hello everybody. This is Ken Goldberg with DSETRADING.com, reviewing the markets as of July 24, 2015, starting with the Dow. We're looking in the upper right-hand corner of the screen, the daily bar chart. As you can see, the last week or so has been pretty dramatic on the downside for the Dow, which is approaching the lows of July. It is far out in front of the NASDAQ, which is making new highs this week, but there's one index, which I'm about to show you, which is leading even the Dow. As you can see, the Russell actually took out the lows of July, the Russell 2000 today, and closed really at the lowest close since going all the way back to May. I'm going to blow this up because, like I said, it is the leader, and it is giving us a message, and that message is, hey, perhaps this is an actual head and shoulders top, left shoulder over here, head in the middle, right shoulder here, and now this neckline that we've had drawn for several weeks now was just broken on a closing basis on a Friday, which is a very negative sign. Typically, I'm going to bring this up a little bit, typically as this blue arrow shows, which again we drew a couple weeks ago as we put the neckline in, typically after a break of a strong line like a neckline, we'll see, even if we see a little bit further decline towards this 1214 area of the 200-day moving average, we'll see a bounce back to test the underside of this red neckline, which has been support going back to May. If that happens and rolls over and fails, then that test is what we call the kiss goodbye. And that is one of the big markers when a market has actually turned. So that's what we're going to be looking for in the last week of July here. A potential test of the 200-day moving average around 1210 or so, give or take a few. Maybe a bounce back towards 1230, which would look like down here, up back here, somewhere in the 1220s. And then if that is in fact a kiss goodbye, then this head and shoulders pattern would give a measured move down towards 1120, so 100 points off the Russell, which is pretty substantial. That's going to be 8 or 9%. As we can see, the stochastics on the daily basis have not only rolled over, but have put in a lower high, just like price has. So unlike the stochastic and price divergences that the DSE looks for and sets up as warning signals, members of our services know that this decline we've been talking about throughout most of July is a five-wave decline, an impulsive move. We expected a lower high, we got the lower high, and stochastics did not diverge but made a lower high themselves and are now turning down in what we call free fall, which is when the red stochastic starts to separate from the green stochastic. The last time we saw that was late June, early July, and this was a similar period of free-falling daily stochastic. This is much weaker, potentially. Going back to the Dow, blow that up, equalize it. Don't have the classic and orthodox five-wave decline. This could be a series of ones and twos and ones and twos, and it's starting to get pretty negative here. The stochastics are in free fall, and there is several days of further decline in price and stochastics before the green zone is hit, which is when the first attempts of some type of bounce typically occur. This big red line here that we've noted as the 2000 to 2007 resistance line was broken above in the last year or so, and it is about to come into play if we get some type of further decline in the Dow. So that will be kind of the worst case scenario for the next couple of weeks, 16,700 range, because that was such a strong resistance line for 7 years. Like back here in October of 2014, lower left-hand corner of your screen, like a plunge below that line resulted in another attempt to bounce a test or plunge below it again, we'll at least get a bounce back to it. We'll get more detailed that in the next couple of days to weeks. See it continue to fall towards there. While I have this blown up, let's quickly look at the difference between the Dow and the S&P 500. The S&P 500, it came within 1 point, which is technically a lower high, which allows us to move this possible blue 2, if I can grab a hold of it, there we go, up to here. I can jigger around these letterings, but that's not important. What's important to see is that stochastics are in free fall, and the biggest down bar since late June just occurred today on July 24th. That's a big bar. So we've seen the Russell, the Dow, and the S&P 500. Let's take a look at the NDX, which is the NASDAQ 100, which, alone with the NASDAQ composite, did make new all-time highs this month in July, after last making them in April. The pattern, as we've been talking about since April, this area here is sideways and corrective and overlapping, which is why we got the signal from the DSE that it's likely that a new high would come. Now we've had the new high. We've got it in what appears to be an impulsive fashion. Prices went up to and reversed at the upper 2 standard deviation band and the upper Bollinger Band, that purple dotted line, and have reversed. The most bearish thing about the reversal is that a very rare gap island reversal was generated. You see how going up higher here, we've got these various types of gapping bars, and then the final gap up to the 2 standard deviation band occurs, and then prices are reversed in a gap lower. This leaves what's called an island of price separated from the rest of the pattern, and that is typical of an exhaustion or terminal point in the rally. So now what we would expect is to see very sharp selling in the NASDAQ over the next couple of days that could last throughout July, or most of July, certainly until the daily stochastics, which are just beginning to be in free fall conditions where the red is separating from the green. Certainly there should be strong selling while the stochastics come all the way down and test or break below this 10% extreme, which is where the daily stochastics become oversold and where we look for some type of a short-term bounce. Now, there's support down here between the lower Bollinger Band at 2290 and the 200-day moving average at 2328. We could see that this coming week. What we're really looking for is to see this line from the January and February lows tested. I'm going to highlight that because it's a long way down, but something that should be looked at, because prices have the ability to get down into this zone right here. I can take this little stripe off, because this is where we should see prices falling sometime in the next several months. And I'm going to quickly show the NASDAQ composite, which was a little bit stronger than the NASDAQ 100. And I'll show you the difference. Here we have the island gap reversal and no attempt to refill this gap. That's weakness. I'm putting up the NASDAQ composite now, the strongest of the two NASDAQ indexes. And as you can see, here we have the gap creating the island, and the next day prices went up and closed that gap here before falling down. So even the strongest of the strong, the NASDAQ composite, the strongest index of all in this recent last few months of activity, has now done its minimum expectation of filling the gap and has rolled over. And again, it has the biggest down bar since late June, which, although a bounce followed, there were lower and lower prices. So we're expecting the stock indexes to have a very weak last 5 days of July. The week of July 27th through 31st should be extremely weak for all indexes, including the strongest of the strong, the NASDAQ composite. Let's move along to the bond market. Here's the chart of the 30-year bond futures. Here's a screen of them. And if you look at the upper two charts, the weekly in the middle and the daily on the right, it really shows what our count and expectation has been for the past several weeks. Bonds fell in 5 waves from the April highs. DSE not only gave us that high, but gave us this low. We covered most, if not all, of our short bonds here, and rather than get long, we awaited this rally up towards 156 to 158 to happen, and as of Friday, we're starting to see tests of 154, 155, and we actually took short bond positions today and this week as the stochastics on the daily basis. I'm in the upper right-hand chart here. The stochastics here were double topping with the early July peak as price was making similar stretches, and so we got short in here again, allowing for more ladder rungs to be added if prices stretch up into the 157, 158, but certainly not requiring that move to be made before we move into short exposure. We want to be short bonds because this is a consolidation. I'm on the middle chart now. This is a consolidation of this decline, and when this consolidation is over, whether it's here at 155 or it gets up into the 156, 157, at least this area of the September of 2014 low and the December of 14 low should be met. And I'll definitely lightening up if anyone's still long bonds and we're preparing to get short, if not getting short right here. Dropping down to crude. Members of our services know that last summer, we warned that the crude bounce, I'm in the upper left-hand corner, this crude bounce up into the 108 area was a wave 2 bounce after this 112 area of 2013. And we said that we expected a break of the 2012 low, which we got in this massive accelerating liquidation of crude, which started to form a bottom down here in March. DSE was warning at this entire February-March period that shorts in crude should be covered and expect a multi-week, a multi-month rally that would probably get up into the 60s. We got that. We're not sure if this was all of the rally or whether it was just the first wave of the rally. This decline will be the separator, and then we get another wave that maybe tests the low 70s. But it's not required to get up there. Daily stochastics are almost oversold. I'm sorry, that was weekly. Weekly stochastics are almost oversold. Daily stochastics are oversold. And in the upper right-hand chart where I now am, you can see that this decline from 63 in May to the current lows near 47, 48, has occurred in what looks like a 5-wave decline. So now at least a bounce towards 56 should occur this coming week, the last week of July of 2015. It should either occur or begin before much lower prices are seen, and those much lower prices will break, I'm on the middle chart, will break this low, the March low near 43. Those lows will break. They'll either break in the next few weeks and finalize the decline from the 2013 peak near 112, or we'll see a brief bounce up into the 65 to 73 area, followed by an eventual break of this March low near 43. Regardless, though, the next multi-day to multi-week move should be a bounce from somewhere in the 46, give or take 2 points, up into the 56, give or take 2 points. And from there, the DSE will tell us whether there's further bounce coming or whether that's all and it's going to roll over. Take out 43 and head into the 40, give or take 2 price zone, if not a little bit lower into the 30s, into the lower 30s. The euro actually looks short-term bullish. As you can see, far upper left-hand chart is the monthly chart. DSE gave us this low near 104 we're not sure if the bounce and decline is all of wave 4, which is kind of in Elliott terms of a way to track the progress, or just the first part of wave 4. And as you can see, I'm in the middle weekly chart, upper row. This is either wave 4 or wave 4 will occur out here on one new rally up towards 118, but we don't know what's happening yet. It looks pretty constructive. If you take a look at the far right upper chart, daily stochastics crossing up, unable to take out the lows from May, and so we think that there will likely be a move up into the 1.17s, give or take. Probably not as high as 1.20, probably a little higher than 1.4 and a half, 1.450. So the euro looks a little bit constructive on the short term. However, any break below the May low, which is about 1.08, and the euro should be on its way to below 1.04 and test eventually parity, which is 1.00, where the euro and the dollar have equal value. That is the big forecast that our members have seen us continually put in writing since 2008. Here's the big monthly chart since 2008, where we forecasted that this was a multi-year high, if not the highest prices ever to be seen, and that at least parity of 1.00 would be seen, and here we are within knocking distance of 1.00. Now what happens from then? We'll have to see what happens, but certainly odds are that we're going to see that parity tested, because we don't think the 104 from March is quite a deep enough test. We think there's at least one more new low coming. And then let's go take a look at gold, which the DSC has been pounding the table on all this week, as Monday found, I'm in the upper right-hand chart, the daily chart, Monday found a spike down through the 3 standard deviation band, almost to the 4 standard deviation band, and then a bounce that we warned in writing that the DSC said probably not the lowest low we're going to see, probably going to see a break of that low. We got that today on July 24th. It did not last, but it was a great buying opportunity, which we talked about. And although the market spiked lower at the open, it finished at the high of the day, and that might be the final low in gold for at least a run on 1300, which would be 230 points, or about 22% off that low. Very bullish in gold. Daily stochastics oversold, weekly oversold and crossing up, monthly oversold, and then here's an interesting point. Check it out. I'm going to switch it to silver now. Look at the same chart. Silver never got below the 3 standard deviation band, unlike gold that spiked through it and tested the 4 band. Silver made a lower low in price, but kept above the 3 standard deviation band. We've been drawing this triangle, expecting this price to fill in the triangle, come into the apex, and explode out, and that may, as gold spiked down again and silver spiked down, took out the low of the July 20th, and it reversed and closed almost on the top tick of the day. So what do we expect? We expect probably a retest in silver to 1450-ish. We would be expecting this type of action to move silver, there we go, up into the 2013's high. I'm on the upper left-hand chart now. You can see that that big bold blue line is highlighting this contracting triangle from the spike high of 2013. And breaking back up through that line, I'm on the weekly chart in the middle, which kind of crosses in the next few days to weeks the 1680 level. Breaking up and closing above that line is going to get the shorts to scramble for the hills, cover, and create at least probably a test of at least the 2250 area, if not a test of the 25 area. And we could see that as the stock market rolls over and starts to get pretty ugly, which is the mere opposite of the precious metals market. So we're very bullish here on gold and silver. We've established large, long positions in silver because it bullishly diverged from gold. It didn't make lower lows that tested the 4 standard deviation band. It held above the 3 band, and that is where we stand. So thank you for joining us. This is Ken Goldberg, and we'll see you soon.